All right, let's bring in the Schwab team, taking us into the last 7 minutes here. Collin Martin and Kevin Gordon are with me. Collin's director and fixed income strategist at the Schwab Center for Financial Research. Kevin is a senior investment strategist at Charles Schwab. Gentlemen, great to have you here. Congrats on making it through the big day. Still standing. And I don't know, did the market lose its head, Kevin, or is this reasonable?
No, I think it's just a reaction to the surprise of, things having been figured out maybe much sooner than what had been the consensus. I think the consensus is probably somewhere, within a week or 2 weeks time of figuring out who the winner was, especially for the key battleground states. But, clearly that's not the case. So you've kind of unleashed all of that pent up momentum in pretty much, one session. The one thing I would note, what's really interesting, at least from a U.S. equity perspective, is that even though you are seeing pretty significant gains up and down the cap spectrum, definitely stronger down the cap spectrum, breadth is not as remarkable as what you would expect when you've got, more than a 2% day for the S&P, more than a 3% day for the Dow. You're at about, just slightly under 3-to-1 advancers relative to decliners for all NYSE stocks. So it's a great day, for the market broadly, of course, and you've got key parts of the market that had been lagging a lot in this bull, but are now really starting to wake up. And I think that's a good thing. But I would say that the breadth profile is not yet as strong. We had a stronger day yesterday and much more tepid gains. So just one thing to keep in mind when you've got a rally like you do today.
All right. Basically the same question for bonds, Collin. Is this abnormal, market losing its head, or just a continuation of what we've seen for like the last 2 months?
I'd say it's not a continuation. This is a significant shift for us. We're changing our outlook a little bit. We've seen such a move up in Treasury yields. If we go back to the past 6 weeks or so, we think a lot of that was justified really just on the economic resilience that we've seen and the idea that the Fed might not cut rates as much as expected. But as we look ahead and what the potential policies could be under a Trump administration, we think that's pulling up yields even more. If you look at the combination of tax cuts, tariffs, and potential immigration policies, we view a lot of those as inflationary. So inflation has been trending lower, although it's been a bit stickier than we'd expected. I think the risk now is that it stays pretty sticky and maybe even reaccelerates a little bit from here. I think it's too early to say. There's a wide range of possibilities what could happen, but I think that's really what's driving the markets right now. And it really comes down to what the Fed reaction function will be. And we've seen those expectations shift even more. If we look ahead to tomorrow, we're not expecting a change there, 25 basis point cut. When I say not expecting a change relative to what our expectations were already, we are expecting a cut tomorrow because the data, I think, supports that. But I don't think the Fed's going to adjust policy based on what could be over the next 2 months. They'll want to see what happens there. But any way you slice it, we'll probably see a pause at some point, potentially as early as December, mainly given the economic resilience that we've seen.
Okay, so just to be clear, Collin, you guys, the view of higher yields is a new thing, right? Because last time we spoke, you guys were looking for yields to stay basically flat. I think Kathy even said that the idea of rates moving up alongside the Trump thing was overstated, which generally I agreed with coming into this, which was that the yield move basically since the Fed day of cut kicked off this whole kind of pro-cyclical theme. So does the view change now because of Trump specifically, or because those themes were already in action?
It's probably a combination of both, but when the facts change, we're going to change our view. And when you look at the results of the election, it was strong support across the curve for the Republican side, and I think that allows a lot of his policies that maybe they wouldn't have gone through if we didn't get such a strong backing in terms of the Senate or the House, which we're still waiting on, but it looks like maybe it could end up being a full sweep there. So our view has changed, where, as you alluded to, we thought the move up in yields recently was a combination of really the strong economic growth and maybe the potential for the Trump victory, but we weren't expecting a really reacceleration of yields. But now we do think that is a risk. And if we look ahead, is the risk to higher yields or lower yields? We think it is to higher yields. How much and how quickly, I think, is open to debate. But because of that, we are a little bit more cautious about extending duration. Now, we backed off our extending duration call a few months ago, and then just within the past 2 weeks or so, kind of pulled it back forward again because we thought it presented an opportunity for investors to lock in attractive yields. But right now, we're kind of focusing on a benchmark average duration or even a below benchmark average duration.
Okay.
So we don't want investors being caught off guard with their bond holdings should yields continue to rise, which could pull their prices lower.
Got it. Mr. Gordon, I got two questions I want to ask you, but we're only going to have time for one. So you take whichever one you think is more interesting. I trust you. Because one is like, I want to ask about just kind of the quality skew, basically. Should investors essentially look at this and go, you know what? The quality factor worked. That's what I should stick with. Or the other question is more kind of the bond question about tomorrow is, what if anything in this administration tinkers with the Fed or Powell? How rough would that be for the stock market?
I mean, the first question is a little bit easier to answer in the sense that, yeah, I don't think that the quality trade has completely faded away. I think it still makes sense, especially if, to Colin's point about the Fed maybe having to pause or maybe keeping rates more elevated. That's still relatively more restrictive, at least compared to what you would have gotten if the Fed continued to ease and maybe had a little bit of a lower terminal rate. To the second point, I mean, that's the unanswerable question right now. I think from a tariff perspective and from a policy perspective, that has the potential to hamstring the Fed a little bit more, because we know, just based on history, that tariffs are more supply shock driven, or they at least lead to more supply shocks. That is harder inherently, just objectively, for central banks to combat. So if that's the environment that we're going to be in, where more of the policy is driven by tariffs, then it's just harder for central banks to be able to deal with that kind of inflationary impulse that results from it. So yeah, I do think down that road, it would probably result in a flipping of the stock bond correlation going back to negative territory, the stock price bond yield correlation in particular, going back negative, and then potentially becoming more of a depressant for equities if yields continue to rise.
True. Okay. A very good point on the inflation side. I was more thinking like, what if he starts trying to move Powell around or talk with the Fed? But then that's probably getting in the realm of speculation. Appreciate you guys. Thank you very much.